Huge retirement planning strategy no one talks about, part 2. We're going to clean it up a little bit from what I did last time because some comments which were very helpful in terms of adjusting things. So let's again, that was just a stream of consciousness. What I was doing to that, it's like it was a new concept to me, and I said that seems to be working. So let's after 2 days of thinking about this and seeing your comments, let's clean this up some and see where we come out. All right. So let's just go back real quick. We got we're going to go to the dashboard. Oops. We got $501,000 and $501,000 is our net worth, and that consists of, we got $500,000 roughly and $501,000 in my IRA, and I got 1 share in a stock account of the S&P 500. I'm fully invested in the index S&P 500, no bonds, no cash. So I expect a 7.4% annual return with a standard deviation of 16%. All right, so the Monte Carlo will flow in this nicely in terms of the ability for this to last. I don't know. All right, so we ran the numbers last time and it came out pretty interesting. All right, so let's just go real quick. So I had some people. What about expenses? Look, man, I'm just saying at the end of the day, my total expenses. Let's get rid of this real quick. I'm just going to share what I'm talking about. Oops. My total expenses are going to be $4,000 a month. That covers health insurance. That covers that's going to cover everything. Some people say, "What about taxes?" It's included in I'll show you. So we'll get into that. So that's $4,000 a month is our total expenses. I hope that makes sense. So if we go to retirement, we go to cash flows. I'll show you what I'm talking about. We go to cash flows, retirement cash flows. Our expenses are going to be, you can see, oops, let me go down here a little bit. Yeah, you can see 48,000, 49,000, 51,000, 52, 54, 55. So they're going up by 3% a year for inflation. All right, so that's what's happening. Taxes are coming out of the investment portfolio. So let me show you what I'm talking about here because I get this a lot. And I've showed this to you a bunch of times. So that's okay. We got a lot of new people on the channel. So, all right, so let's go. Ending balance by accounts. All right, so let's just go to taxes so I can nip down the bugs. I get that a lot. You're not showing taxes. It's coming out of the account, man. I'm telling you. All right, so as we sit here today, we have to take $48,000 a year from our portfolio because we don't have any Social Security until I'm 70 years old. Does that make sense? At 70, I'll take it, and we'll get $55,000 between Charlotte and me. Until then, we've got to get $50,777 in the first year to come from someplace, and the $2,777 comes from taxes. Is for taxes, $48,000 is living expenses. Well, that's got to come from someplace. It's not showing up in Social Security, so where does it come from? Well, if we go to ending balance by accounts, we go to withdrawals from accounts, and we'll see we're taking $50,000 a year out. We're spending $40,000 a year, but we got to take the bulk of that to include taxes from the IRA. So I'm only pulling $48,000 to live on, but I am pulling the rest for taxes. I hope that makes sense. This is coming out of the taxes. So the IRA, the full distribution, isn't just my expense. It's the expense plus the taxes. Same thing happens with Roth conversions. When you're converting to a Roth, it will show you in the software. You're converting $25,000. But if you're not having the taxes come from a taxable account or some other account, it's going to come out from the IRA. I mean, the taxes get paid, and I'm just telling you, the taxes are accounted for in the software. I cannot stress that enough. All right, so essentially what I need here is I'm going to need $50,000. That's 100, 200, 300, about $375,000 over the next 10 years, essentially 9 years, to pay the bills until Social Security kicks in because I'm not doing Social Security. All right, so I'm like, hey, that's great, but let's take a look at the analysis and let's take a look at, we'll go down here in confidence. So I'm not likely to run out of money, but look at that. If we have a couple of down years here, by the time I'm 69 years old, by the time I'm 69 years old, if he has a couple, if it goes against me, I only got $19,000 left in my portfolio. Now, there's only a 5% chance of that happening, but that's still a significant, that's a significant risk. There's only a $19,000 left in my portfolio if I get crunched, and that's where the variability of the Monte Carlo analysis is 16% standard deviation on a 7.4% rate of return. That would concern me. I was like, I don't know, man. And then 25% of the time or less, I only have 166,000 in there. All right, so that's pretty significant. I'm like, I don't know if I like that. So we go over here to comparisons. And let's just say we run and we have a bad decade of growth. I mean, look at this. This right here is a current, and the current is we are down to 31,000 under the that's if I had a bad decade. We are down to 31,000 by the time I'm 71 years old. That's on average. I don't use this very often because it's just on average, and I don't really like the averages. But still, it shows you at the end of the day, a bad decade followed by some negative slow growth, you're down to $31,000, and that's not going to get the job done. If we have a flat 0% rate of return, you can see again, I'm down to 103 by the time I'm 71 years old. So I start with 500,000. 10 years later, I'm down to 100,000. Now it'll always go up at that point because Social Security kicks in, so I'm fine. But still, now if we have a strong growth scenario, you can see that just goes up and up and up. No problem there. But Fed adverse scenario followed by modest growth. Look at that. So the Fed has a adverse scenario where they're really kicking, we'll say they're fighting inflation, raising interest rates like crazy. Almond stocks, don't fight the Fed. Both the current and the proposed. If this happens, I am down to $0, if that makes sense. I got no money. I run out of money on average by the time I'm 69. So I say, I don't like that. So what we want to do then is we're going to say, so this right here is fine. This is the Monte Carlo. On the median, I have 1.75 million at my death to leave to the kids, or Charlotte's death because she'll survive me. Actually, it was going to right here. This has me taking Social Security at 70, and this has me taking Social Security at so looks taking Social Security at 70 or taking Social Security at my full retirement age. So you definitely want to take Social Security at your full retirement age here. So we'll just put that in there. Not going to change a whole lot, but still you can see. All right, so yeah, here we go. So taking Social Security at my full retirement age, I have a 99% probability of success with 1.828 million. If we go back to comparisons, you can see right here with the Fed adverse scenario, I'm looking at $2,000 by the time I'm 70. That's not going to get the job done. So I'm like, yeah, I don't like that so much. I know it looks good, but there could be some problems for sure, and that's not good. So all right, let's do this. So what I want to do, again, going back to what my Social Security is. So if we go back here, and I'm saying my income is Social Security is $2,900 a month for my PIA, my primary insurance amount, and Charlotte's is I think I'd have $1,000 a month. All right, so basically between our two Social Securities, depending on when we take it, it's going to be between $3,500 and $4,500 a month. So that's going to basically take any kind of income we need off the portfolio because we'll have enough for Social Security depending on when we take it. All right, so what I want to do, I want to go to net worth, and I want to go and I say we're going to do two things here. We're going to do half of this. We're going to take, so we got 1,880 shares. So we're going to take half of that, and we're going to leave it in the S&P 500. So 1880 divided by 2, 940 shares. All right, so we're going to take 940 shares, and we're going to leave it in the S&P 500. And that means we're going to take our 250,000 and annuitize it. Now, I need to be clear. I cannot stress this enough. When you pull money from your IRA and annuitize it, that is not a taxable event. The annuity is still under the context of an IRA. You're not taking a $250,000 distribution, and because you're dropping an annuity, it's taxable as ordinary income. It's not how it works. You're still keeping it under the umbrella of the IRA construct. I hope that makes sense. So I got a lot of people say, but you didn't pay tax on the distribution. You don't have to pay tax on the distribution because it's still going to be a trustee to trustee transfer. We're transferring it from the S&P 500 at Vanguard to a Vanguard immediate annuity within the context of an IRA. Now, as the income is received, as I get the money off the annuity, that is taxable as ordinary income for sure. So let's just go to Schwab. Some folks said, how are you getting a 6%? No, it's good. So we'll look at real distribution scenarios here, and we're going to say we're going to invest $250,000, and we're going to go here, $250,000. We're going to start this. We'll just start 1st of January. My date of birth will say 0101. Well, actually, what was my date of birth? I forgot. What did I say my date of birth was here? Family. My date of birth was 1157. 1157 in Charlotte's is 1159. 1157 and 1159. So date of birth 111 0101 1957 male 0101 1959 female. All right, and we're going to say we live in Tennessee. again, just because we don't want state income tax. And this right capital doesn't have the state income tax, correct? So how much will they pay out here? You gotta do like that. Boink, boink. Oops. All right. And we gotta do another boink and another boink. All right. Boink. Let's see how much they'll pay. So in this case, they're gonna pay monthly income $1,000 a month. I want 20 years certain. So $1,000 a month on that 250. So how much? That's about a 5.5% payout, right? So we got 1,016 times 12 divided by 250. That's a 5% payout. It's 4.8. So less than what I had anticipated. It's not a huge amount less, but still, we'll just say $1,000 a month for simplicity. All right, so we're going to get an annuity of $1,000 a month. We're going to have income, and we're going to have this annuity income of $1,000 a month. It'll be $12,000 a year, and it's not adjusted for inflation. 100% survivor. Looks good there. Sweet. Okay, cool. So let's just make sure I got everything situated here. We're going to have net worth, $250,000 in the S&P 500. We're annuitizing a half of that to get an income stream for which we can't outlive. And then we'll annuitize it where we keep the other half in a cash account to draw on. So what's happening here is we're gonna have, let's go to cash flow. So let's look at retirement and see what we got. So it drops a percent of 85%, which I'm still very comfortable with. Let's see confidence. Oops. Again, the confidence goes down quite a bit. At 69, we have a median of $88,000, which is scary, man. Because we're keeping it in the S&P 500. But once we start taking Social Security, we're fine. But still, look at that. I mean, you're talking 5% of the time you ran out of money, 25% of the time or less, you only had $37,000. So that, that gets a little bit scary. In fact, when I'm 69, 25%, up to 25% of the time, I only had $27,000. So that's that can be dicey. If we go to comparisons here and we get a Fed, and we're going to run out of money. Yeah, look at that. We're running out of money at 66, 67. So, if we have a Fed policy that hurts us badly, we are running out of money in this case. Is that necessarily a bad thing? I'll show you what I'm talking about. A flat 0% rate of return. We ran kind of over there out of money at 69. And then we bad decade, we run out of money again. So remember, what does running out of money mean? Well, it means we have no liquid assets, right? But we still have, from a cash flow perspective, watch this. So even though we ran out of money, we still had net flow. And this would be hard to say because this is on average. But anyway, so here's our cash flow. And so our income flows are Social Security for Charlotte at 62, and then for me at 70. That's probably not. Let's go to current plan. I want to do Social Security at full retirement age. Yeah, let's do that. Change it. Okay. Hold on a second. Doesn't look like it changed it, does it? So let's go and. Yeah. Okay. So let's go up here to profile. We're going to do income, Social Security. We're going to take it at 67. Yeah, that's what we're going to do. Let's see what that looks like now. And retirement. Yeah, 100%. Okay, that's good. That's good. So taking Social Security at 67 at full retirement age, we get a 100% chance of success, which is good. That means every single time we had money left. Let's look at the confidence. Yeah, the median there never drops below. Looks like 173. Not one time we have 0. The least we have for 25% or less, or up to 25% of the time, we have 65,000 in the portfolio. So that's still pretty good. Let's go to comparisons. Let's do a bad decade. Yeah, we never run out of money there. We come 65,000. That's not great, but Fed averse, we come pretty close to run out of money. And when I'm 67 years old, but I still got more than enough income to live on because Social Security is going to kick in that year. We go to income. We should only have, yeah, look at that. We're fine. So we never have any shortage at all. 100% of income is stable because it comes from Social Security or annuities. I'm telling you, man, this is a great freaking strategy. This is a great freaking strategy. Expenses, 48,000. Got your tax payment. Let's take a look at the taxes here. Yeah, look at that. So that is fantastic. That is fantastic. All right. So remember, we have reduced by $250,000. Just FYI, I've taken the annuity out So it's not sitting in cash and the stock market like I did before. So that's pretty fantastic. My man Sergio was saying Wade Fowler's book talks about an increasing equity portfolio. That works a lot. Let's look at accounts. Oh man, I'm stoked by this. I really am. Taxable accounts, because our traditional IRA is down to 230 to 182. Then we kick in Social Security, and now it's all being over here in this taxable account, which is growing. If we go to, I think it's invested account. Yeah, portfolio return. There we go. So here we got beginning balance 302. We made $32,000, $22,000 on 32. Yeah, 6.8% rate of return when you factor in distributions and whatnot. So net cash flows is $20,000 because we got that's good. That's good. I like that a lot. I mean, look, man, look at these taxes. Yeah, I mean, let's look at the tax return. Again, $2,700 in taxes in that year. Let's go to 2000 and we'll go down to 2027, 28. $700 in income tax, $61,000 of Social Security benefits. Only $13,000 is taxable. That's just oops. Let's go to and then you got RMDs right here. A 4B. That's our RMD. Yeah, in that, look at that. We got $78,000 of Social Security. We got $28,000 of RMD and annuity distributions. So we have, what's that, 28 plus 78, that's $106,000. We're paying $3,000 on $106,000. Man, that is just beautiful. That is beautiful. All right, so what if we did this? Let's put it in cash instead. I'm just curious. So we'll go to profile. So let's uncheck this. We're going to say we're not going to include in plan. Instead, we're going to put $250,000 in cash. All right, so basically what we're doing now is we're saying, okay, we're going to take the $250,000 from the portfolio, and instead of putting in the S&P 500, we're just going to move into cash so we can draw on that. Let's take a look at what this looks like. And now it's not going to make any money. I get 1% a year rate of return on that. Yeah, so still a good probability of success. A lot less upside to leave to the heirs, but 100% probability of success there. Still leaving $400,000 though, and look, watch the confidence will never drop. Yeah, look at that. I mean, we're still sitting at 116,000 median. I mean, you're never coming anywhere near zero. Between 5 and 95% of the time, in our worst year, we get 112 to 123,000 because it's all sitting in cash. If we do comparisons, oops, let's do that here. Yeah, we never come close. Well, actually, let's do this. Fed, it shouldn't matter. Yeah, it doesn't matter. So if you do it, put it all in cash, and you have a bad decade, it literally matters not because you're not in the market. You're having an annuity, but it's not in the market. Now let's go to cash. This man, dude, I am on to something. My man Harry, this is freaking awesome. So what you'll see here, my friends, we'll go to additions to accounts. There shouldn't be any here. Yeah, no, but now we got additions to accounts because now our Social Security and our annuity are dwarfing our expenses. So we're adding all this back into the accounts. And let's see. I want to go to invested assets. So they still got me. Yeah, so it's not making any money here. So what we got to go back doing. Yeah, it's not making any money. It's still sitting in cash, so it's only growing at a 1% clip. So what we got to do then is we got to go to profile, and we got to say, don't touch that. Can't touch this. Don't touch this. So how are we going to do that though? So we're going to go to retirement because they're taking it from that account. Yeah, so they're taking it from the taxable account. And I want the taxable account to be invested still. So how do I do that? So we got income. We need cash flows. What we'll do 36. So we're gonna say, Yeah, okay, we'll say 40,000. Okay, bear with me just, this will be interesting. So I'm going to pause for a second. I don't know how to get it to go back into the investment account as opposed to just going to cash. This is confusing to me. So I'll email the guys later. Actually, let me try one of them. I have the accounts in this where I don't get how to make it go into the S&P 500, because what's happening here is, I have to email, like I said. What's happening here is we have, if we go to accounts, all right, we're taking money from the savings accounts, as you can see here, the taxable accounts. So we're taking 160, probably not that, 100,000 bucks, 125,000 bucks, and we'll see the ending balance by accounts. The drawback, so we got 134,000, which is in cash. But what I was hoping they would do, and I don't know how to do this, so we'll have to figure this out. What if I go to proposed plan? Will that change anything? Well, maybe that will change them. I bet it won't. I don't think so. So let's just see. We go to vested asset. Yeah, it's not doing anything. All right. So basically, what's happening here is I'm saving money by not spending it. So essentially, with your Social Security and your annuity, you have additions to accounts. So we have all this money right here later on down the road going back into a taxable account. For some reason, it's defaulting into the savings account and not going into the investment account, which is too bad. That's I mean, either way, that's fine. I mean, it's not fine. I wish I could do it where they half went to the savings and the other went into the investment. I don't know how to do that. But worst case scenario, we still have $100,000 with a 403,000 liquid net worth at our death. We talked about the confidence. We're never coming close to running out of money. I just don't know how to change it to go back into stocks. Now, if we go back to here, profile, and we say, well, let's cancel this guy here, and we'll undo that, and instead we have it coming out from our portfolio. All right, so now we don't have it coming from the cash. We have it coming from the portfolio. We still have the same annuity. So that works kind of the same because anything that's being invested is going back into an investment account that's growing with investment rates of return. I don't know why I can't get it on the taxable side. It's weird. So I'll show you what I'm talking about. So before we had 100% with 403,000 median liquid net worth. Now I have 100% with 1.4 million median liquid net worth. And the reason for that is solely because, A, we don't spend all of our money down for the S&P 500, and B, our accounts, if we go to invested accounts, these guys are growing with the market. A $13,000 portfolio return on $182,000 is about 7% portfolio rate of return. So I'm not sure why I can't get it the other way. Either way, so in this case, so to solve the riddle is we have between 400,000 and 1.4 million of liquid net worth at your demise, depending on how you invest your money outside of whatever you do for the annuity. All right. So again, we have 500,000 bucks. We take half of that, put into an income annuity. We ran the Schwab scenario that says how much can an income annuity pay for the years that we're doing, which is $12,000 a year, joint life, and 20 years period certain, which is what you want to do. So we know we're getting $12,000 a month, all right, $12,000 a year. So we're taking that, and we're going to go up here to put it into profile. We're going to put it into income, $12,000 a year, all right. And then we have our Social Security, which is on the high end. I grant you, for me, $2,900 is on the high end, but $1,000 for Charlotte. That's not extraordinarily unlikely. It just is not. Now, could you say 2,500 per? Yeah, you can do whatever you want, but that's a successful retirement plan. If you do the annuity and put the money in cash, and then take the money that you're going to get off once Social Security kicks in, man, you're in a good place. I'm just curious. What if we took Social Security early? You're just in a good place. You don't have to worry about running out of money. You leave money as early as possible. You're in a. Yeah, here you still got $1 million, and if we go back, that's just, man, that's a good place to be. We want to include this and then exclude this, so we can take Social Security early. So I'm not double upping on the amounts. That's what's going on here. 98. So look at that. We take Social Security early, and we're not invested at all in the stocks. We just have in cash. We have a 98% probability, but only 52,000 liquid net worth, and that's still misleading simply because. Aha! Yes, there we go. Okay, cool. But that will, see, that's not right because it's still going to take the cash and make it. Either way, we know what the bottom is. We know the bottom is that you're going to have, roughly $400,000 if you do $250,000 to an income annuity and take Social Security at your full retirement age, and the income and the $250,000 is left in cash. Or you could have $1.4 million if you do take $250,000, leave the rest in stocks, and put that $250,000 into an income annuity. And then whatever you have above and beyond the spending once Social Security kicks in goes into the stock market as well. You never run out of money. You have a decent amount living. I love it, man. I think that's a freaking great strategy. It deals with the sequence of return risk. Man, I'd love to hear your thoughts on this. I'm a fan. I am absolutely a fan. So, all right, I'll let you guys talk. I'd love to hear what your thoughts are. So let me know. Thanks now.